I just watched this clip of Grant Cardone get into a heated argument with somebody else about 401ks and how they work, and it left me a little concerned. Take a listen.
You don't pay any taxes when you sell, when you pull out money out of your 401k if you wait until you're 63.
When you start using that money, you're going to pay taxes, bro.
When you pull the money out
And start using that money, you're going to pay taxes.
you're not paying taxes. When you pull money out of your 401k.
You weren't charged taxes while it sat there. What's wrong with you?
401ks are the most popular investment vehicle in the United States, but the studies show that most Americans have no idea of how they work. But that stops today, because I'm going to be going over 5 things you need to understand about your 401k, from your taxes to your fees, because yes, your 401k has a fee. Number 3 is control. Number 4 is limitations. And number 5, alternatives to your 401k. That way you don't make the same expensive mistakes that millions of Americans are making. So let's jump in with number 1. Talking about taxes. Your 401k lets you defer taxes. It does not let you avoid taxes. And the amount of taxes you're going to pay and when you pay taxes are going to depend on if you have a Roth 401k or a traditional 401k. So let me start by talking about the traditional 401k. If you make $1,000 from your job, and then you put this all $1,000 into your 401k, that means all $1,000 gets to go into your 401k. The money then grows in your 401k for as long as your money is sitting there. And then when it comes time for you to retire, hopefully this $1,000 will grow to say $10,000. You pull out $10,000 out of your 401k. That's when this money is going to be taxed. So you get taxed when you pull the money out, but all $1,000 gets to go into the 401k. With a Roth, it works a little bit different. Now, you make that same $1,000. And you want to invest this money into your 401k. But before you do, you pay your taxes. So now the money is taxed before it goes in. Now, depending on what your tax rate is, meaning how much money you make, you might be paying, say, 30% of this money in taxes. So now only $700 goes into your 401k. So you have less money working for you. But then when you go to pull this money out, you don't have to pay any money in taxes when you pull this money out. So if the $700 grows to $7,000, well, now you don't have to pay taxes on the $7,000 because you paid taxes here before the money went into the 401k. So you still have to pay taxes. Your 401k just said to defer taxes when the money is growing inside of the 401k. With a Roth, you pay taxes before the money goes in. With the traditional, you pay taxes when the money comes out. Now, when you're making the decision of which one's better for you, a traditional or a Roth, the main question that most people ask is, well, when I go to retire, what's my income going to look like? I'm not going to have a job, so I'm not going to have much income. So my income is going to be lower, so my tax bracket is going to be lower. So because of that, I should pay taxes when I pull my money out, which might work for some people. But for others, that might not be the best analysis, because if you are, let's call it, more financially savvy, and your goal is to grow your investment income, and by the time you retire, you don't want no income, you want a lot of income, well, then you would have a higher tax bracket. Not to mention, you want to pay attention to what's happening in the economy as well, because we know that our national debt is always breaking new record highs, and our government keeps spending more money, which means our government has more and more needs for higher taxes, which means that there's a potential reason to believe that we will have higher tax rates in the future, which could impact how much money you pay in taxes again in the future. But you got to pay attention to what you're doing in your personal finances and what's going on in the broader finances to decide what's better for you, a Roth or a traditional. If it was me, I would prefer a Roth, but again, I'm not you, and I'm not a financial advisor. I'm just a random guy on YouTube. The second thing that you want to pay attention to are fees, because yes, your 401k is costing you a fee. This fee is called an expense ratio. So your homework after this video is take a look at what funds you're invested in with your 401k and take a look at what that expense ratio is, because while it might not seem like a big amount of money, it can add up to a lot of fees in the future. Because this fee that you're paying isn't a one-time fee that you pay today. It's a fee that you pay on every dollar that you invest and every dollar of profit that you make for every year that your money is invested in your fund. And this little fee can end up costing you tens of thousands or hundreds of thousands or even millions of dollars in little fees that you can adjust just by paying attention to what the fees are. So let me give you a little hypothetical. Let's assume that you're investing $1,000 a month in your 401k, and you're going to do this for the next 40 years. And let's assume that your money is going to grow by, say, 10% a year on average. If your expense ratio is 0.07%, that means when you go to retire, your 401k would have right around $5.2 million sitting there. But if you have a little bit of a higher expense ratio, say that your expense ratio is 0.85%, well now you're not going to have $5.2 million. You're not going to have $5 million. You're not going to have $4.5 million. You're going to have around $4.2 million because that additional $1 million went in fees, assuming you got the same return. You're investing the same amount of money for the same amount of time. That $1 million is going in fees to your money manager. This is why you want to see what this expense ratio is. And I hate to tell you this, but many people are paying even higher expense ratios than this. I have seen people paying 1.5% expense ratios, so you can just get an idea of how much money is going into Wall Street's pockets. I want most of this money going into your pockets. So your homework is to go figure out what your expense ratio is and see if you're paying a higher expense ratio, are you getting the higher potential returns to justify paying these additional fees? By the way, if you like to stay up to date on what is happening in the financial markets when it is happening, well, I created a free newsletter called Market Briefs, where my team is working to keep you updated on things like the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link for you down in the description below. The third thing that I need you to understand about your 401k has to do with control, more particularly control from your employer and control from Wall Street. When it comes to your employer, some employers, some companies will offer you a 401k match, which says for every $1,000 you invest in your 401k, your boss is going to give you an additional $200, an additional $500, maybe even an additional $1,000. They'll match it at 100% contribution. But what you got to understand about this is some employers are going to put restrictions on how this works, meaning a vesting schedule, which says that in order for you to actually get that money and keep that money for yourself, you have to work at the company for at least 5 years. Now, every company is going to have different rules and regulations on this, but you want to understand this just in case you quit, just in case you leave, or just in case you get fired. Because this could be a way to keep you at a company longer than you might like. Now, this has a lot of benefits to you because it's kind of like free money in a sense that your employer is giving you more investment money, but I wouldn't say it's free money because you're still working for it. However, you do want to understand the controls that might be tied down to it as well. So what you want to pay attention to is your vesting schedule, meaning if you were to leave your company and your employer is giving you a match, they're giving you some money into your 401k, when do you actually get to keep that money? Because if you have to be at the company for, say, 5 years to get that money, you want to understand that and not potentially lose it without knowing you're going to lose it. So just something for you to understand. The second thing you understand when it comes to controls has to do with Wall Street. Because when you invest your money in a 401k, what you're doing is you're investing your money into a fund. You're generally not going to be able to invest in individual companies. Like you can't take your 401k generally and invest it into the Tesla stock, or Nvidia stock, or Amazon stock. What you're going to do is you're going to invest this money into a set of funds that your employer has partnered with. Now, what ends up happening here is you're pretty limited on where you can actually invest your money. Like you're not going to most likely be able to invest your money into real estate. You'd have to invest in something like a real estate investment fund, if you're even given that option. And so what you want to think about and remember here is when you're investing in a 401k, this is just one vehicle. It's not your only investment vehicle. I'm going to talk about alternatives at the end of this video, but just know that you have limited control when it comes to investing with your 401k because you have to invest your money into whatever those money managers offer you. And those money managers then pretty much manage your money for the next 10, 20, 30, 40 years. And they're going to charge you a fee for every year that they manage your money, and hopefully they make you a profit. And even if they don't make you a profit, they still charge you a fee. So it's something you want to pay attention to. It's something that you want to watch because if you have very limited options, you might want to look at what your alternatives are as well. And the last thing that I want to mention here when it comes to control has to do with rolling over your 401k. So if you leave a company and now you no longer have that 401k, you might have the option to roll that 401k into something like an IRA where you have a little bit more control, where you can invest your money outside of those funds and where now you have control over the money as well. So something for you to think about, especially if you're moving from one company to another, where you're moving over 401ks as well. The fourth thing that I want you to understand has to do with limitations. And this used to be one of my biggest issues with 401ks. I've kind of softened up to them a little bit more over the past number of years, but I used to be very against 401ks. And the reason was because you were very limited on your investment options. And then I started to realize that, well, for many people, that's okay. For some people, maybe not, but for many people, it's okay. But I want you to understand that your 401k is a great place to start investing. It's not where you want to stop investing. This is your beginning to invest fund. This is that tax-deferred account to get you started with your investments, but this should not be your only or sole investment fund. So when I talk about limitations with the 401k, what I mean here is, well, kind of like what I just said, there are a limited number of places where you can invest your money. You're going to get a few funds where you can invest your money, and that's pretty much it. You can't diversify out of those things. And you might say, well, Jaspreet, well, I invested some of my money into a growth fund, into a blue chip fund, and into an emerging market fund. Aren't I diversified? And no, you're not, because all of your money is tied up in paper investments. All of your money is tied up with money managers on Wall Street. So if the stock market crashes, all of your funds go down. Maybe some will go down more than others, but you get hurt when the stock market goes down. That's not real diversification. And this is where I want you to understand that when it comes to your 401k, it's a great place for the average person to start investing. But it's a horrible place to keep all of your investments, because you got to have some more investments outside of your 401k. That might include investing your money outside of your 401k into an IRA or into individual stocks, into your self-directed account. That might mean investing your money into real estate. That might mean investing your money into startups. That might mean investing your money into other alternative assets outside of these basic investments. But you have to invest your money outside of your 401k as well. So don't treat your 401k like your only investment, make it the beginning investment. And this brings me to number 5, the alternative to your 401k, because the 3 asset classes that have built more wealth than anything else in the United States over the last century are stocks, real estate, and businesses. Now your 401k is one way that you can invest in stocks, but it's not enough. What are other ways that you can invest in stocks? Well, you can invest in stocks through something like an IRA. But that's also not the only way. You can invest in stocks yourself by opening up a brokerage and then investing in something like an index fund, a mutual fund, or an ETF. These are 3 ways to invest in groups of companies instead of investing in individual companies. You can also invest in individual companies using different brokerages, because now you can invest in companies that you believe in. But I think for the majority of America, 98% of America, you should be sticking with funds. For the 2% of America that wants to be a little bit more sophisticated, that wants to be a little bit more involved with their investments, well, then you can consider investing in individual companies. Another way is you can invest in real estate. Now, when you invest in real estate, you're looking to buy properties not to live in yourself, but to rent out to other people. This could be single-family homes. These can be apartment complexes. These can be office buildings. These can be retail buildings. These can be mixed-use buildings. These are properties you're buying not to live in or use yourself, but to rent out to other people. The third thing you can do is invest in businesses. Now, again, when you invest in stocks, you're investing in a business, but these are non-publicly traded companies. So this could be your own company. This could be other startups. There are brokerages and funds on the internet which allow you to invest in other startups. This is a way now for you to invest in newer startup type companies. But understand, this comes with the most risk, but also the most potential upside. And what you want to remember here is what I said just a minute ago. Your 401k is a great place to start investing, but please do not make that the end to your investments as well. Your credit score is not a measure of how much money you make, and it's definitely not a measure of how wealthy you're going to become. Your credit score shows how likely you are to pay back your debt, but it's not even that accurate. Oh, did you just cancel a credit card? Well, now your credit score just dropped 45 points. You've only had a credit card for 3 years? Minus 61. You don't have any debt. You have a 0 credit score.